One of the most frequent questions we get from clients is that they have multiple loans and they are at the same rate. And they're making prepayments, so which ones should they prepay first? And so that's what we will be discussing in this video today. So the short answer is it doesn't matter. And what I mean by it doesn't matter is that if you're making prepayments, it doesn't matter if you're applying it to this loan or that loan. If they have the same rate, you're going to pay exactly the same amount, and it's going to take you exactly the same amount of time to pay down your loan. However, there is one free benefit that you get if you implement a certain strategy, and that strategy is paying off the lowest balance loan first. So that's what we're going to explore in this video today, of why that actually gives you a free benefit. So for our example, we'll assume that you have two loans. Loan number one is $25,000 at a 10-year term and 6.85%. And loan number two is exactly the same, except for the loan amount is $15,000. Now the column in our example that needs to be pointed out is this monthly payment column. So your required monthly payment is $288 for loan number one, and it's $173 for loan number two. But you think that you can make an $800 prepayment because you want to hurry up and get out of debt. So you can now prepay $338 a month, and that is a discretionary payment, meaning it's not required. Therefore, your total payment is actually $800. Now, if we take that $338 prepayment every month and apply it to loan number two, we end up paying that loan off in 2 years and 9 months. And that's where the benefit comes in of this strategy. You see, after you make that payment and you pay down loan number two, all you have left is loan number one. So you'll see that your prepayment, or the discretionary payment, goes up to $511. What that means is you've given yourself more flexibility after 2 years and 9 months. Because if something happens to you, or whatever reason, you just don't want to make that extra prepayment for a given month, instead of saying, okay, well, I need the cash, putting $338 in your pocket, you'd be able to then put $511 in your pocket. So this strategy really just gives you flexibility, which is one of the number one things that we talk about when it comes to financial planning, and that's giving yourself as many options and as much flexibility as you can. So this strategy is a pretty simple one. If you have two or more loans at the same interest rate, then you target your prepayment towards the lowest balance loan first. Now, as always, if you are making prepayments, it's essential that you check to make sure that you're making prepayments instead of paying ahead, because it can save you thousands of dollars. So we recommend, if you haven't done so already, to check out our video titled, "Are You Making Prepayments Correctly?" Because again, it could potentially save you thousands of dollars if you're doing it incorrectly. For more videos, you can visit fitbucks.com, or if you would like us to look at your personal situation and come up with a strategy for you, feel free to email us at info@fitbucks.com.